Hello everyone, I'm Isa Martinez, trader and market analyst at xChief. This week has been filled with critical market events, from geopolitical tensions and earnings reports to surprising moves in the crypto space. In this video, we'll break down the key macroeconomic drivers and then dive into technical analysis on the dollar index, S&P 500, Euro USD and Bitcoin. If you're looking to stay ahead in the markets, you are in the right place. This week is packed with key economic data that could move the markets, so let's take a look at what's coming. On Tuesday at 9 a.m., we have the JOLTS job openings report. This tells us how many job openings there are in the US economy. A higher number means companies are hiring, which signals strength. But if it drops, it may suggest the job market is cooling. Then on Wednesday, things get serious. At 7:15 a.m., we get the ADP non-farm employment change, which gives us an early look at how many private sector jobs were added or lost. It's not the official number, but it often moves the market because it sets expectations. At 7:30 a.m., the advanced GDP for the second quarter is released. This shows how much the US economy grew or shrank. It's one of the most important indicators of economic health. A positive number shows growth, while a negative one could increase fears of a slowdown. At 1 p.m., we get the federal funds rate decisions, followed by the FOMC statement and the press conference at 1:30 p.m. This is a major moment. The Federal Reserve will tell us if they are changing interest rates and, more importantly, how they see inflation and the economy going forward. Even if the rate stays the same, the wording of their statement can shake the markets. Then on Thursday at 7:30 a.m., we get three big ones: the core PCE price index, the employment cost index, and unemployment claims. Core PCE is the Fed's preferred inflation measure, so traders watch it closely. The employment cost index tells us how fast wages are rising, which can also affect inflation. And jobless claims let us see how many people are filing for unemployment benefits. A spike could be a warning sign. Finally, Friday is Jobs Day. At 7:30 a.m., we get the average hourly earnings, the non-farm payrolls, and the unemployment rate, all at once. These are critical. Markets often move sharply after these reports. If job growth slows or unemployment rises, traders may expect rate cuts, but strong numbers could push the dollar up. At 9 a.m., we also get the ISM manufacturing PMI. It tells us how the manufacturing sector is doing. If it stays below 50, that means contraction. Above 50 means growth. With the economic calendar covered, it's time to zoom in on the latest fundamentals driving investors' behavior this week. US stock futures held near record highs on Friday as investors wait a week packed with earnings, trade developments, and an unusual visit by President Trump to the Federal Reserve. The Dow ticked up slightly, while the S&P 500 and Nasdaq 100 remained mostly flat, marking a pause after several record closes and a strong weekly gain near 1%. Optimism got a boost from the new US-Japan trade pact, helping fuel early momentum. However, analysts now question whether the rally is truly based on strong fundamentals or just FOMO, fear of missing out. Looking ahead, traders are eyeing a critical week ahead with the Fed's two-day policy meeting, the monthly US jobs report, and major earnings from Apple, Meta, and Microsoft. Plus, the August 1 deadline for countries to reach new trade agreements with the US or face retaliatory tariffs adds more tension. Meanwhile, reports indicate that US-EU deal is facing friction over profit sharing from a proposed $550 billion investment fund. Back home, Trump downplayed speculation about firing Fed Chair Jerome Powell despite his criticism of the Fed's $2.5 billion headquarters renovation. Finally, Intel beat revenue expectations in its latest earnings release, but the stock slipped after announcing layoffs and scrapping several factory projects, raising concerns about future growth. Let's now move on to the analysis of the most important assets, starting as always with the strength of the US dollar. We've seen that the dollar has reached all of the targets we outlined last week, specifically the 97.714 and 97.271 zones. From that last level, the price has shown a significant reaction. It's highly likely that the dollar will now attempt to recover those zones. A key target for the upcoming week should be around 98.099, and there is an area near a vacuum medium block, the point where our liquidity gap begins, and the most important part of that block is located at 98.595. A final bullish target for this coming week could be 99.421, assuming the current structure holds. However, if the structure weakens, it's unlikely that we'll see a strong recovery that would suggest the dollar might continue to seek lower lows. In that scenario, a downside target for this week would be around 96.377. Now let's take a look at the S&P 500. We're seeing a strong bullish move that it's attempting to break through the final target we had previously identified based on our own analysis, and it was located here at 6,385 level. It's highly likely that the S&P 500 will reach this point, and from there we could see a potential correction zone emerge. For now, we maintain our bullish bias and keep 6,385 as the main objective for the upcoming week. However, since we're recording this on Friday, if the price breaks above this level, the next target could be around $6,400. On the downside, I'm watching 6,281 and 6,201 as key liquidity zones where the price could correct and absorb orders. If neither of those levels holds, the correction could extend down to 6,132, from where we might expect the bullish trend to resume. We remain bullish on the S&P 500. Unfortunately, for those looking to short this market, it might be a difficult environment as long as this structure and bullish momentum continue to hold. Now moving on to the Euro USD, we've seen a correction in the Euro's price following, logically, the recent recovery of the US dollar. If this corrective move continues, we'll be targeting the 1.16720 level. Should the correction deepen, additional downside targets could be 1.16145 and finally 1.15571. However, it's unlikely we'll see a significant correction unless the dollar shows stronger recovery, given the inverse correlation between the two. On the bullish side, upside targets for this week remain the most recent high at 1.17889 and the next potential resistance at 1.18299. To wrap up the week, we turn to Bitcoin, and as I mentioned before, we're still seeing a range-bound market with no clear directional breakout just yet. Despite that, our bias remains bullish. It's likely that Bitcoin could continue moving higher, especially considering that this upward movement might extend into October or November before potentially entering a bearish cycle based on historical halving data. For now, our upside targets remain at 119,176, followed by 120,320, and finally, this point I'm not targeting the shadows, I'm targeting the bodies of the candles, 122,751 USD. On the downside, there are two clear targets visible on the 4-hour chart. The first is 114,567 USD, where we find a fair value gap, or also called imbalance, and the second one is at 112,430 USD, with the liquidity zone even lower at 110,541 USD, all of which could act as correction levels. If you found this analysis helpful, make sure to give this video a like and subscribe to our channel for weekly insights. And if you want to take your trading to the next level, open your account today at www.xChief.com and join a global community of traders. Thanks for watching, and I'll see you in the next update.